For traders that have emailed and asked, the links for the free downloads are in the description box below. Just click on the link or copy and paste and put that in your browser. The 4-step method to high performance trading and the 7-step daily routine for high performance traders create the rituals, the mindset, and the winning attitude to master the markets. Bulletproof yourself with your daily routine and your habits. Force yourself to be getting better, 1% better every single day. How good can you get, traders? Again, the free downloads, the links are down below. They're both free courses. Let's get started. G'day, traders. Stacey Burke from Stacey Burke Trading. Today we have a great topic, and that is, what do you do when the markets get blown out? Meaning that they get all out of whack, or they're distended from, we had a big day on the Fed last night. Markets have obviously been moving, and great question from a trader. What do you do when the markets get blown out? Today we're going to talk about that. The number one thing that I focus on every single day, we're going to repeat and hammer home the process. The process is what allows you to come to the market no matter what's happened and identify the best candidates potentially that may be setting up, and then filtering out the poor quality ones and monitoring how the market sets up. Number one thing, as always, is I stick to my process. We're going to go over that in detail again today. Short video. We'll cover everything, coming back to simplicity, duplicatable, scalable, reproducible trade setups. Now, I talked specifically about coming to the screen for the New York Open. Now, couple of things to clarify. Number one is I will not get in before the news. We had double news. We had 8:30 or 8:15, 8 and 8:30, BOE for the British pound. And then at 10 a.m. we had ISM, red news. So as I talked about, if there is a trade on something separate, maybe gold or oil in that first hour, recognize that may be that first hour trade to take money off the table. When the New York market opens, 9:30, equity market opening time, is when I'll tend to look for the market to be coiling for an explosive move, or to already have coiled for an explosive move, a trend trade, reversal trade, or just in a trading range. We could be in a trading range for the session. Low of the day, high of the session, high of the day, low of the session. That sort of scenario, as opposed to a high of day, low of day, high of week, low of day, low of week, high of day. And then recognizing whether or not the setup itself is something I can put size on. So just to clarify, scalping in and out and getting pips is not the same thing as having a trade setup that you can put size on. And so, obviously, if you're an expert at scalping in and out, and you can do that consistently day in and day out, the number one question I always have is, could you add size onto that trade? And when I say size, I mean increase your size, not loading the boat on there. A sizable setup, great question, if I can only take one setup, what would that be? And of course, it's always high of the week or low of the week, always. Now, that comes with a couple of setups in mind. Taking a high of the day, high of the week trade isn't always the same as taking a level 3 high of the week for a short trade measured move. It could be a high of the week, high of the day to the low of the session trade. There are two different types of setups. When I get a high of the day, high of the week opportunity that has the setup with trap volume from the previous day for a measured move, that is a sizable setup. That is totally different than just having 3 levels of rise on the day for a high of the week, high of the day to the low of the day trade. But when I get the size trades, S&P this week was a perfect example. On day 2, high of the week, sizable opportunity, trap volume in the upper quarter, 250 pip box. That was a 500 pip move. Now, I didn't have full size on that 500 pip move, but I had full size on the first part of that move and trailed the rest because we had news on the calendar. Decision I made. It went to 500 pips. But those setups are scalable. So me scalping in and out, it's not this, when traders message me and show me little scalp trades, the number one thing that I'm focused on is the reproducibility and the simplicity of executable trade setups that can be reproduced with size, because your performance dictates increasing that size, not because you are scalping in and out on these trades and you're getting results, so you just decide to increase size. Because some of those scalps are intraday little swings inside of order flow. So as you have bared witness to several days trading, you can see the entire day can become order flow for a large explosive move that is over fast. One trader messaged me today, knocked out 50 pips in 15 minutes in oil. Perfect trade. We'll talk about that. Third hour trade setup. So the process is about setups, not about pips. Scalping in and out is not the same as taking setups that reproduce over and over again. And when you get trap volume and those setups start to move through that order flow, they're not coming back. When you understand that concept, then you realize how, sometimes, obviously London, British pound, euro, Swiss franc, day 2 today, after the Fed, explosive huge moves in the London session. We had BOE, so the pound a bit different, but Swiss franc, great day 2 trade in the London session. Sizable opportunity, a coiled market, continuation. So, and again, as I mentioned, entry, stop, take profit. Now, timing is key. So we have news at 10 o'clock. I automatically think, first thing I'm thinking is that 10:14 is probably going to be the earliest I'll trade. And we'll talk about a couple of scenarios. I haven't talked much about third hour coils, but we'll review those. And then taking the money and walking away. And the reason being is that the markets will change. As much as you think that they just keep trading, the algos kick in and the type of price action will change. So what looks like a trend all of a sudden ends, and it's timing based. Everything's timing based. The time of day. So for the hindsighters out there, if you can learn to tell time, you'll be able to start to see trades setting up and coiling to the minute of the clock. And then having a review process. How did you trade today? Sometimes you need to monitor your headspace. So you get into these markets, you hear chatter, you've got voices talking to you about getting in and taking a trade and then not taking a trade and waiting and being patient. And there it goes, I missed it. Get in now. And then, whoa, I shouldn't have got in. I shouldn't have done that. So when you have a process that's ironclad, I repeat, ironclad, nothing will scare you from going to the market each day, laying out your setups, and then letting the market set up to see if that trade actually comes to fruition. One thing that I can assure you of is that these markets, no matter how they appear, tend to often give 1 or 2 great trades or more every single day. Are you going to get them all? No, you are not. But when you understand the process that brings you to a particular instrument and allows you to develop a thesis and then let the market trade and set up. We talk about timing, hourly rotation, 15-minute rotation. I cannot emphasize enough the importance of understanding the rotations of time. Then also understanding who's in the market. Up high, if they trigger the high of the day, is the new hour. Have they triggered a new hour into the market, a new hourly breakout trader, a new 4-hour breakout trader at the high of the day in the US session? Those sorts of scenarios. If they've triggered the high of an hourly trader, where do you think that trader's stop is going to be? Most likely on the other side of that hour. The same thing applies for a 4-hour chart. So I talked yesterday about the filter. The first thing I look for is a filtering process. Now we had a big day yesterday on the Fed. Obviously day 2 is first green day, but we traded back down to the low of the week, 3 peaks, breakout pullback. So we have a first green day on day 2, but the follow through green day, 2 bull candles, day 1, day 2. Day one of the first day for longs being triggered in the market, first green day. We have an opportunity in the London session for longs. They've come down, they've triggered the high of the day, and they do a dump and pump into the London session. Now, we have a market that has broken out. I talked about this yesterday. This is what, when I come to the screen in the morning, I'm looking for markets that have broken out or have broken out the previous day at the high or low of the week and failed. Trap volume at the high of the week, which becomes our new day one. And we'll talk about that. So we have a market that's distended out 3 levels of rise, Canadian dollar. Now, this is just something that jumped out to me because it had gone up again in that vertical move. This is a textbook 3 peaks formation setup, very similar to gold yesterday, high of the day trade, a little different variation, same thing though. So when I come to the screen, I see this market distended out. What is my process? My process is always, where is the high of the day before the session starts? Right before the session starts. Somebody said to me yesterday, well, how do you know where the high and low of the week is if the week isn't finished yet? And how do you know where the high and the low of the day is if the day isn't finished yet? Listen closely. When I go to trade a session, there is a high and a low. If the market has been making higher lows, that becomes the last low of the London session. That is the high of the day. That's the high of the day. Now I want you to think about what happens as soon as they break this high. First minute of the new hour in the 12 candle window. What have they done? They've just triggered hourly breakout traders. Hourly breakout traders are in the market at the break of that candle. Now, I'm not trading that. What time do I go to work at? 9:30. But we have news on the calendar, so I'm aware that at 10 o'clock the market could still be trading or trapping volume, and so maybe 10:14, 15-minute false move, this is my thinking. That's sort of when I'm going to be looking for a trade potentially. But I know that the first hour will often make a high and a low. They come down and trade back into that low and start to proceed higher. So there potentially is the low of my first hour in the US session. Of course, we break out, we take the initial breakout candle high out, and we go up higher. That tells me that the high is not yet in place yet. The high of the day is not yet in place yet. Why is that? Because we're still going higher. But we have a higher low. I'm not looking to go long. I'm at the high of the day. What am I looking for? I'm looking for a high of the day setup. Now we talk about front side, back side, and all I'm looking for is volume to be working its way into the high and some indication of a break in structure. Now, 30 to 45 minutes will often lock in the high. I state that over and over again, 30 to 45 minutes. The next hour can have a break in structure and trade back up into that high, and the high might already be locked in, I don't know. Trade back up into that high and trap volume, but we may have a break in structure. We get our break in structure in the second hour. Again, this is prior to the New York market opening. So we have our break in structure. We have hourly traders long in the market. We have most likely their stops have gone from the previous hour's low to the low now of the first hour of the US session. The second hour breaks the high of the first hour. We may still be going higher, except that when New York opens, it auctions down and breaks the low, the initial low of the first hour. We have a new break in structure, lower lows and lower highs. The high may be locked in. Now, you've heard me say this before. I will take a pin. That hourly level got broken. They made a pin on the first bar. That pin now could be the high of our day, and these peak formations after we break structure now potentially is my high level, the high of the day level. When they make the lower low, that's when the pump and dump is what I'm looking for. They pump it up after the New York Open, prior to the news, back up into the high of the day. The news candle is just a non-eventful pin up and down. That confirms my thesis. No explosive move, no vertical candle, no breakout, no stop through the high of the day. That pin is just a whipsaw. Now I can enter the market. The news is over when I get the confirmation of my trade. We get our peak formation back up into the high of the day, an engulfment. And what time is this at? The end of the 15-minute candle after the news. 12 minutes in, I'm into the market. This was an awesome setup, high of the day, different variation, opportunity to add positions in. Remember, I talk about the breakout candle, the vertical candle anywhere in this space, back inside to the low. Once that candle drops, I'm done. Anything inside of this little box, this little space where the vertical candle goes, once I'm in the market, I will add. As soon as that little bar is broken, I'm done. My 1 bar stop is above the peak formation high. It should not come back. If it comes back, I am wrong, and I want to be wrong as fast as possible. Now, first thing I want to look at is does this trade have the potential to go to the low of the day? Well, we had higher lows. The new low of the day for London is up on top of the breakout of the Asian session. This area right here where breakout traders are in the market at the quarter level roughly is a reasonable target, which allows me to target 50 plus pips roughly. Market could have the potential to follow through, and as I always talk about, the bulk of the position comes off. On this particular situation, I actually exited the whole position. And coming back to looking at the overall chart, the thesis is that we are still on the front side of this move, meaning that although this trade broke down, we are in an upward moving market. So this is different than trading a vertical move at the high of the week, level 3, that has the potential to drop all the way maybe to the low of the week, whatever. We are in an upward moving market. A no stress trade, 50 pips out of the market, and this two-sided auction process on the way down is a good telltale sign that once it reached the profit target, to take the whole position off. So we can look at the British pound. Obviously, 2 sets of news on the calendar. London traders today had an awesome opportunity for a first red day trade. First red day, I look for 3 peaks. First red day, 3 peaks. It could be the US, it could be London. Obviously, British pound has the potential to move in London. The market comes down and puts a low of the day in place. Low of the day, now I'm looking for 3 peaks heading into the open of the London session. 1 push, 2 push, 3 pushes. We have volume trapped up high. And this is prior to the London session. So again, if I'm trading the London session on day 2 after the Fed and we have first red day, I'm looking for 3 peaks in that London window. So again, the market's gone 3 levels of rise. You can go and review those videos. You don't have to get too complicated. You can pretty much just draw a box. There's a box of trap volume. We break down. We make our high in the first hour. First hour high. We're already short. The market is in a downward market. If you're looking to buy inside, this is the reversal trend trade on a first red day after 3 peaks. This is a fully loaded opportunity. The end of the first hour heading into the open of London, the market is already short into the open of the session. The market coils sideways for 30 to 45 minutes, gives us our M double top. I am just getting in anywhere and I'm adding positions and I'm holding on to this. This is the all session fade. First red day, all session fade. This market just continues to grind slowly and collapse, and there's bottom pickers looking for the low of the day in an all-day fade. You will get crushed on these. We had BOE at 8 and 8:30 US time. What does that tell me? In most instances, I'm either going to look for a first bounce, a vertical collapse, 3 peaks, 15-minute setup on the news itself. So we had 8 and 8:30. Or I'm going to wait until the New York Open. Now, I find that the pound doesn't have a lot of huge movement in the US session, but again, there can be continuation trend trades, low-hanging fruit, and sometimes obviously there are going to be reversal squeezes. So first thing we look for after the news, we have 8 o'clock and 8:30, we have our first bounce prior to the 8:30 news. Now again, if we're waiting for after the news, so again, first bounce after the BOE, Governor Bailey was speaking at 8:30. My own general feel on this is you could probably put a small position in on the first bounce opportunity anywhere underneath in the second 15 minutes after the news. Governor Bailey spoke on the second bounce, and that market just continued to follow through for a nice 50 pip collapse. Now, somebody asked me yesterday, did I trade? Did I get in at the high or the low on the Fed? And I just said I don't even have any interest. I know it's lots of volatility and everything else, but I'm just not interested. That's not my approach to the markets. I leave that up to the cowboys and to the people who like trading that stuff. Again, the question I always have is how much size are you going to put on it? When you talk about getting in those types of volatile markets, is it realistic, or are you just getting in with micro lots and trading it? Because having a sizable trade opportunity is how you're going to build your business and make your living. Gambling and taking high risk volatility is a great way to potentially get blown out on the black swan day. The day that you think you can get in and bang, it goes another 100 pips in about 3 minutes. So not part of my playbook, not interested. I broke that train of thought years ago, and I don't even look at it. I just, come back the next day and look at what happens and how it sets up. So the process we're talking about is there's news on the pound. There's a first bounce trade on Governor Bailey speaking. Again, it's an all-in short session. If you were looking to trade after the ISM 1700, the market again understanding two things. Hourly traders triggered at the low. Breakout traders triggered at the low of the second hour prior to the New York Open. So again, they break the hourly low. So if you were shorting that or holding on, think of it more like holding on to a short trade. Okay, so we have two areas where traders have potentially entered the market after Governor Bailey spoke and on the first bounce opportunity. Okay, we have hourly traders triggered into the market. The third hour opens and trades down into the low and reverses. Now, this is not something I would trade, but this is the third hour trade setup for the short squeeze. And they go vertical back into the shorts from the beginning of the session. So again, when you understand that breakout traders are involved, the high of the second hour is right here. If traders have shorted this and the market swings back down into the low, most likely their stops are going to be above that middle hour. And when that third hour opens, they come right down and trap lower level shorts following that perceived trend before engulfing and exploding back vertically and expanding the range for the third hour, going back long in the other direction. Now, obviously, they came back later, but I'm just talking about chasing moves down low and looking at a reversal. This is a first hour, second hour, third hour short squeeze setup. Okay, again, Euro very similar. We have a day that's blown out. By the time we show up for the US session, we have a low of the day from the London session. The process is always the same. Where is my high and where is my low? That's the London high and the London low of day. The most recent swing high, we have a lower high, obviously. They take that out in the first hour. We have hourly traders triggered into the market. That first 30 minutes, first 15 to 30 minutes, they take out the lower swing high before auctioning back down into our low of the session. Now, I don't know, this could break down and take out the low. I'm not trading until 9:30, and because we have news on the calendar, I'm thinking this could be a third hour trade setup. We have a break in structure, and we're shorting back down into the low. When you are shorting back down into the low of the day, you need to be thinking short squeeze, even if it's just a reversal stop hunt. If you're shorting this down low in the US session, and it's not going anywhere, get very, very suspicious. But most importantly, for the hindsighters, instead of trying to read every little bar, start paying attention to the clock. New York opens at 9:30. We have hourly traders triggered at the high of the day. We know their stops are at the low of the day. The second hour breaks structure on the inside, but not any hourly highs or lows. But we have an hourly high now for that middle hour, and then we have a higher high in that middle hour before the third hour opens. Higher highs, that's called a break in structure. We haven't broken the hourly high yet, but our third hour now opens, and the same thing happens. They come down into the peak formation low made in the last 15 minutes of the second hour. The news candle is essentially, again, nothing inconsequential. We have a V bottom, and there's our V bottom reversal engulfment, third hour. They've worked into the low. We've had a break in structure. It breaks and explodes through the lower high of the second hour. We have trap volume down low, and they go vertical. Not quite 50 pips, but still an explosive short squeeze opportunity. Major round numbers are 50. So again, thesis is always get in as best fill as possible. If I can't get in at 50, I'm just going to get in. And I'm going to get in until we break the high of where that move started, or the most recent bear candle at the bottom. That's our reversal pattern. So again, understanding stops have been hit, breakout traders have been triggered, hourly traders have been triggered at the breaks of these highs of these hours. Their stops are underneath the most recent hour. They come back down into that hourly low, but they don't take it out. They break structure on the inside. No hourly levels are broken. Before that middle hour finishes, they break structure again. Higher highs, higher highs. Dump, dump, dump. 1, 2, 3. New hour engulfment, V bottom reversal at 50 for the explosive short squeeze back through the lower high of the session. Great question from a trader. When we get markets that have blown out after the Fed, or we've had lots of volatility and lots of movement, do you just stand aside? No, I just stick to the process no matter what market it is. I look for pairs that, as I mentioned, that have broken a level, or they've failed from a breakout level, especially as we get closer to the end of the week. So day 1, day 2, day 3, and oil. Great example, not as reactive to U.S. news, but a breakout that's failed. So again, thesis being we got breakout traders that are in the market. Couple of theses can play out. We got longs in the market. We know that potentially this market could go all the way back down to the previous day's low. Trigger breakouts, hit stops. Trigger breakouts on the opposite side, it fails. We got a market that's broken down. We have breakout traders at the breaks of new hours at the beginning of the U.S. session for a sell high opportunity all the way back down to the low of the day. We have a third hour squeeze opportunity. So again, the process remains the same. Where are my highs? Where are my lows? Do I have a sell high opportunity? Is this going to be a third hour trade, a squeeze, a vertical move back through lower level shorts? Whatever that is, form your thesis, understand the importance of timing and rotation. 1 hour, 2 hour, 3 hours, who's in the market? Breakout traders have been triggered on hourly. Where are their stops? Have they triggered a new hour? 1 hour, 2 hour, 3 hours. It's not going anywhere. We possibly could have a short squeeze opportunity setting up and a coil for an explosive scalable opportunity 45 minutes into that third hour for an explosive 75 pip move. Little things like that. Build your playbook. The process needs to be mastered. Then you can come to any market and determine, number one, is this particular instrument going to offer me an opportunity? What do I need to see setting up? As it's trading, understand the importance of time. Is there news on the calendar? And then go to work. Execute your best trade setups. Take the money. Is it scalable? Is it a scalp? Whatever that may be. Lock it in. Get off the screen. Keep it simple, traders. One more day tomorrow. Non-farm payrolls. Keep it simple. Master the process. Make it ironclad. And may the markets go with you.